Where's the 10-year heading? What are you looking for in terms of detail on the Fed's asset purchases there?
Yeah, Kelly, we think that yields are too low, probably going up in the near term and up quite a bit more in the longer term. And if you read the Fed statement and think about what the Fed's been doing over the last month and a half, it's really trying to buy bonds to make sure liquidity is there and companies have market access. It doesn't seem to be trying to depress yields for their own sake. So we think that does set the stage for yields to go up. Now, not astronomically, but our call, for instance, at year end is that the 10-year goes to 1.25. So we think that's in play, and it wouldn't require too much of a shift in the Fed stance to make that happen.
Well, I'm glad that you articulated what going up a lot looks like, because you're right, it could double from here, and we're still talking about 1.25. Does it stick around, though, Michael? I mean, what kind of recovery, what kind of economy do you think we're going to have as we look out a year or two?
Yeah, not very good for a long time, I think, is the takeaway. And people can debate between V, U, L, W, who knows, some sort of odd letter. But really, when you've got 26 million people out of work, it's hard to imagine a super fast recovery. Our economics team thinks it's going to be a little more challenging than they thought initially. But even so, considering the backdrop of yields, having rates go up to 1.25, perhaps even a little bit higher, seems like it's very feasible.
Mona, what would you add on that when we talk about what the recovery will look like and what the stock market has already priced in? How much does the Fed even play a role in that, or is it just down to the science?
Yeah, it's interesting. I think it's going to be a very sector-specific story. It's not a beta story, and it really hasn't been. If you look at year-to-date performance, the S&P's really been driven by two sectors, healthcare and technology. Those are really sectors that benefit in this post-COVID environment. What's really been lagging has been the cyclical value sectors, the energy, financials, parts of industrials that we talked about earlier. If we start to see more hope building around a real recovery, economic reopening, economic stabilization, you may start to see some of those cyclical sectors start to perform better. And we saw a little bit of that just this week. But generally speaking, when we look also at the more recession-proof defensive sectors, REITs and utilities, they continue to lag, perhaps talking about or seeing that the peak fear of the recession is behind us.
Yeah.
We talk about positioning going forward in a post-COVID world. We continue to like tech and healthcare. That stay-at-home or more stay-at-home economy does well. But we'd like to balance that with a little bit of the financials and energy, but also a little bit of the more defensive. We like treasuries and gold still here as well. David
Kelly, buying gold?
I think it's something to think about long term. I've never said buy gold, but I am. The thing that I'm most interested in is not so much what the Fed does during this, what I think is going to be a U-shaped recession. We know they're all in. They're going to keep rates low for as long as we've got an unemployment rate in the teen. But if this economy comes roaring back in the second half of 2021, at what point will the Fed say, look, we can't just accommodate fiscal largesse forever here. We've got to be somewhat responsible here. If the economy is coming back, we've got to move out here. And to me, that's the really important question, because if they wait too long, we might end up with inflation, in which case real estate, gold, maybe equities. If they move quickly, then I think the bond market may be in some trouble. So I do like equities, real estate, even gold in this environment for the long run, just because rates won't stay this low once we've got a full recovery from this terrible recession.
I was going to ask you about inflation, David, and maybe you can elaborate just a little bit. We can't really know whether the economy is going to heat up and come back quickly, strongly. A hot economy typically means inflation or can mean inflation. But the one thing you can't dispute is that there's a lot of money that has flooded this system, a lot of money chasing goods, chasing services. What are the odds we get into an inflation situation down the road, or do we just not need... It's not something we need to worry about right now, but maybe down the road.
I think the odds are higher than we think. I mean, we've been, we've tested the inflation bomb in the last 11 years. It never went off. But I do think we're going to have even more fiscal expansion, even more monetary expansion this time around. And if we get a more rapid decline or a rapid decline in unemployment, if we get enough momentum in the economy, then that could actually push up inflation. And then one other thing. I want to see if the next government is a little bit more committed to dealing with inequality, whatever government we have at the end of this, because I think that the secret to keeping inflation low has actually been income inequality. If more money goes to middle and lower income households who are really suffering right now, in a rebound, you could have demand outstrip supply, and that could finally bring inflation back. So there must be a limit to how much money you can put into the economy and not generate inflation. And I think we'll discover that limit over the next few years.